Welcome to the introduction on the building blocks of Forex trading. In this chapter we will explore the essential elements that form the foundation of successful Forex trading. In the fast-paced world of Forex trading, understanding the fundamental concepts is crucial for success. Without a solid grasp of these basics, navigating the Forex market can be daunting and overwhelming. Two such concepts, pips and lot sizes, form the bedrock of trade evaluation, risk management, and ultimately profitability. These elements are indispensable tools for any trader aiming to make informed decisions. Pips, representing the smallest price movements in currency pairs, act as the yardstick for measuring profits and losses. Each pip can signify a significant change in the value of a trade, making it a critical metric. Lot sizes, on the other hand, determine the amount of capital allocated to each trade, directly influencing the potential risks and rewards. Choosing the right lot size is a strategic decision that can impact your overall trading performance. Imagine stepping onto a trading floor for the first time, bombarded with charts, graphs, and flickering numbers. The sheer volume of information can be intimidating. It can feel like learning a new language, with its own set of rules and nuances. Just like mastering a language requires understanding its alphabet, mastering Forex trading necessitates a firm grasp of pips and lot sizes. These concepts are the building blocks of your trading vocabulary. These concepts are not mere technical jargon. They are the building blocks upon which profitable trading strategies are built. Understanding them is essential for developing a robust trading plan. Whether you are a novice trader taking your first steps into the Forex market, or a seasoned veteran looking to refine your skills, a deep understanding of pips and lot sizes is essential. These concepts are the foundation of every trade you make. These concepts are intricately woven into every trade, influencing everything from profit calculation to risk management. They are the threads that connect your trading decisions to your financial outcomes. In the following sections, we will delve into the intricacies of pips and lot sizes, demystifying their complexities and providing clear, concise explanations to empower your trading journey. Our goal is to make these concepts accessible and easy to understand. By the end of this essay, you will have a solid understanding of how pips and lot sizes work, enabling you to make more informed trading decisions. This knowledge will serve as a cornerstone for your trading strategy. Remember, knowledge is power, and in the world of Forex, understanding these fundamental concepts can be the key to unlocking your trading potential. Equip yourself with this knowledge, and you will be better prepared to navigate the complexities of the Forex market. Welcome to Section 2, Understanding Pips, the Currency of Profit and Loss. In the realm of Forex trading, pips reign supreme as the fundamental unit of price movement. They are the building blocks of the Forex market, providing a standardized measure for traders to quantify and communicate price changes. A pip, short for point and percentage, represents the smallest increment by which a currency quote can change. This tiny unit is crucial for traders to understand, as it forms the basis for calculating profits and losses. Typically, currency pairs are quoted to the fourth decimal place, and a pip is equivalent to a one-digit change in that fourth decimal place. This precision allows traders to track even the smallest fluctuations in currency values. For most currency pairs, this means a pip is equal to 0.0001. This seemingly minuscule change can have significant implications when leveraged in large trades. For example, if the EUR-USD currency pair moves from 1.1050 to 1.1051, that represents a one-pip movement. Such movements are the bread and butter of Forex trading. However, there is an exception to this rule. Not all currency pairs follow the same decimal place convention. Currency pairs involving the Japanese yen are quoted to only 2 decimal places. This is a unique characteristic that traders must be aware of when dealing with these pairs. In this case, a pip is a one-digit change in the second decimal place. For instance, if the USD-JPY pair moves from 109.50 to 109.51, that represents a one-pip movement. Understanding these nuances is essential for accurate trading. For instance, if the USD-JPY pair moves from 109.50 to 109.51, that represents a one-pip movement. Understanding pips is essential for evaluating trade profitability. Without this knowledge, traders would struggle to measure their gains and losses accurately. The profit or loss in a Forex trade is calculated by multiplying the number of pips gained or lost by the value of each pip. This calculation is fundamental to determining the outcome of any trade. The pip value, however, is not constant and depends on factors like the currency pair being traded and the trade size. Different pairs and trade sizes can result in varying pip values, adding another layer of complexity. Mastering the concept of pips is akin to understanding the value of cents in a dollar. Just as cents add up to make a dollar, pips accumulate to reflect significant changes in currency values. While a single pip might seem insignificant, the cumulative effect of multiple pip movements, especially in larger trades, can significantly impact a trader's profit or loss. This cumulative impact is what makes understanding pips so crucial. In the next section, we will explore how to calculate pip value, providing you with the tools to accurately assess the potential profit or loss of your trades. This knowledge will empower you to make more informed trading decisions. Welcome to Section 3, Calculating Pip Value. How much is a pip worth? In this section, we will delve into the intricacies of pip value calculation, a fundamental aspect of Forex trading that every trader must master. While understanding that a pip represents the smallest price movement in Forex is crucial, knowing how to calculate its monetary value is equally important. This knowledge allows traders to assess potential profits and losses with precision. The value of a pip is not fixed but depends on the currency pair being traded and the size of the trade. Different currency pairs have different pip values, and this can significantly impact your trading strategy. Let's break down the calculation. For currency pairs where the US dollar is the quote currency, for example EUR USD, GBP USD, the pip value is calculated as follows. Pip value equals sign, pip size, exchange rate, x lot size. This formula helps in determining the exact monetary value of a pip movement. For example, if the EUR USD exchange rate is 1.1050 and the lot size is 100,000 units, the pip value would be pip value equals sign 0.0001 1.1050 x 100,000 equals sign $9.05. This means that even a small movement can have a significant impact on your trading account. This means that for every pip movement in the EUR USD pair with a lot size of 100,000 units, your profit or loss will change by $9.05. Understanding this can help you make more informed trading decisions. For currency pairs where the US dollar is the base currency, for example USD JPY, USD CHF, the pip value is calculated as pip value equals sign pip size x lot size. This calculation is slightly different but equally important to grasp. For example, if the USD JPY exchange rate is 109.50 and the lot size is 100,000 units, the pip value would be pip value equals sign 0.01 x 100,000 equals sign $10. This straightforward calculation shows how pip values can vary between different currency pairs. This means that for every pip movement in the USD JPY pair with a lot size of 100,000 units, your profit or loss will change by $10. Being aware of these differences is crucial for effective trading. By understanding how to calculate pip value, you can determine the potential profit or loss for different trade scenarios. This enables you to plan your trades more strategically and manage your risk more effectively. This knowledge is vital for setting realistic profit targets, establishing effective stop-loss orders, and managing your overall trading risk. Mastering pip value calculations can significantly enhance your trading performance and help you achieve your financial goals.